So I thought it would be useful to, before we start talking about the real estate crowdfunding, is kind of start off. So obviously, things kind of started out in the non-real estate world, and so you had sites like Kickstarter, where you can invest in or contribute to, and now they have all kind of different things that you can invest in. Or so if you believe in Dark Beach #1 comics, you can contribute to that.
And then what happens? You give them $10 and what, you give it back?
So Kickstarter, they don't have financial returns, right? Yeah, you get the product. Yeah. So what we're going to find out is, if you're to, as soon as you start selling, quote unquote, selling securities, you're running into SEC regulations there, and so you have to either register as a broker dealer or all these other things. So sites like this, they kind of get around it by, okay, you're not really investing, you're kind of pre-buying, I guess. And so lots of different types of folks use this for their different businesses. Here's another one, Indiegogo. Shows you what you might invest in. Again, help them to fund so that you can sell it. And then here's some of their products that have been funded and are out there. And Microdrone. Some films. So really interesting stuff. Now, I wanted to show you real quick some of the real estate crowdfunding sites so that you kind of get a sense of what we're talking about here. So this is Fundrise. This is one of the popular ones. It's interesting. Fundrise is Ben Miller. So if you went to the event, the capital markets event last spring, he was the guy that was here talking about capital crowdfunding. So he was with us. He's recently opened up an e-REIT. It's like a private REIT that they're doing. I'm not sure exactly why they've started to get into that business, but they are in the crowdfunding business. Yeah, that's that one. That was the income e-REIT. So I signed up for like their newsletters and stuff like that, and been getting lots of advertisements about that. I wanted to show you some of these. Realty Mogul is another top one. I think the Patch has some there. New investments. So you don't get the whole information, the whole prospectus. Most of these sites require you to be an accredited investor. When you sign up, that you're saying that you are an accredited investor, and you can see all their documents and stuff like that. But it does kind of give you some of the target IRRs that they're looking for, kind of an initial investment they're looking for, that type of thing. So.
Charlotte, the top right.
Let's see, Charlotte adjacent. Refinancing. Fully funded. Yeah.
So is the incentive in investing like this is that it's not like a mutual fund or something that you're paying someone a management fee to hold your funds and invest your funds, or you're kind of doing it yourself?
Yeah, well, we're going to talk about all of the different benefits and stuff like that, but the main thing, the compelling reason of why you would want to add something like this to your portfolio is because of uncorrelation. It's not correlated with the market, with the overall stock market. So you might be thinking, well, why would I invest potentially in a crowdfunding when there's REITs? I can just go and invest in a highly liquid REITs. But it turns out REITs act just very much like stocks do when the times are bad. So we used to always say that REITs have a very low beta of around 0.5. So less than 1, so it's less than perfectly correlated. It's going to give you good diversification benefits. Well, guess what? that was when we really hadn't had a bad market. During the financial crisis, that beta was like 1.25, acted more than the market. Now, some of that has to do with that it was kind of real estate oriented, brought the market down. But basically, just when you need the non-correlation the most, you get your correlation spikes up to the roof. And so we've kind of backpedaled from those claims about how safe it is, how uncorrelated. But something that's why direct investment, and not just through crowdfunding, but just having a direct property. Your property doesn't trade on the stock market, right? And so when the stock market goes down, when it really goes down, it tends to take everything down with it, rightly or wrongly, whether your company's in trouble or not. And so direct investment, though, you don't have that correlation. Because they're part of that market. So if you're part of, if you trade on these exchanges and the whole exchange goes down in value, it's just something about the whole market going down that you go down with it. I'm not sure if that's from the money guys just selling everything, and part of when the mutual funds sell, okay, we might own some of these REITs as well, and it goes down. But yeah. That's really shocking to a lot of us. So,
how liquid is this as a vehicle? If you put $1,000 into one of these deals today, can you cash out 3 months from now, or do you have to wait?
Yeah. So again, we probably need to start going ahead and talking about it. So my main purpose on this was to kind of draw you into it and to kind of show you what we're talking about before we start actually talking about it, so you can get a better idea of the subject and stuff. But your questions are spot on. They're in the right direction, or they're things we want to cover. So let's go ahead and get into it. Make sure we come back and address those questions, James. All right, like I said in my email, yeah, there are lots of slides. Some of these we're not going to go over, but because we don't have a textbook for this material, I kind of erred on the side of more slides, and you can just review those as you need to. Here are your learning objectives. And by the way, for your learning objectives, if you see on number 4 here, I would say verse, maybe we say verse Jobs Act. So basically what I want you to know is what in general is the difference between a Reg A offering, a Reg D offering, and the new offerings just recently made available by the Jobs Act. There's going to be some very important differences among those. All right. So we'll be talking a lot about all these different subjects. So this is our primary source for this topic. It is a master's thesis that John McDonald and Bonnie Burgett did, working for under David. You can see it there. David Giltner and Walter Torres, 2 heavyweights in the field of real estate and academics. So these are their master students that they put this together, working on their MSRE at MIT. So it seems like we're playing in the right ball field, right? Having the right colleagues looking at their material. I think, so crowdsourcing, particularly with real estate, is very new. It is not in your textbook. I believe that this thesis was done in order to prepare a chapter, because Geltner is one of the authors on your textbook. So I think they had them do this in order to, as a kind of a first blush attempt at creating a chapter for their book on this subject. All right, so maybe we're jumping the gun a little bit on there, but this is the best document. It was like, I don't know, 200 pages or something like that, and yes, I read through it, and kind of get out all the meaty parts out of there for you, so that you don't have to. It's out there on the internet. If you are interested in it, you can go grab it, knock yourself out. But certainly happy that I don't have to do that again this year. I did that last year, and that took a few weeks. So this is a nice little drawing of kind of what we're talking about. We're going to be talking about real estate crowdfunding, but probably more focused on focused on commercial. But you see how we're kind of at the crossroads of a bunch of different topics, right? So we have the real estate capital market, real estate asset market. So again, the difference here is that this is where real estate competes for capital versus other investments, and so we really think about that your product, your result out of the capital markets is this R, this cap rate that gets generated. Down here in the asset market, what they call the space market, this is where rent gets determined. So this is our cash flow. And so they're going to interact there. It's also at the securities law and the Jobs Act. There's so much legal stuff going on. There's so many lawyers that are getting involved with the crowdfunding. It's crazy. The whole idea, this whole thing is opening up because there's changes in these laws, in deregulation. Then, of course, internet platforms, crowdfunding websites. This probably wouldn't be possible without that technology. So that has an influence there. So we're talking about if you like tech, if you like real estate, and a little bit of securities action in there, this is kind of a nice blend of all those different topics. So these are the key economic terms that we want to apply to this subject. And I think we'll come back to this slide. So let's go over the subjects, and then we'll come back and then we'll see how these apply. So these are some fancy words, some big words that we can use in regards to this topic. Right. So the very first thing we need to know is when we're talking about a subject is how it's pronounced and how you actually spell it and that type of thing. So the first thing I ran into last year was is it one word or is it two words? Are we talking about crowdsourcing as one word, or is it separated like that? Well, it turns out your answer is that it's one word, all one word, right? Another question was if it's crowdsourcing or is it crowdfunding, right? We'll talk about that in just a second. The origins of the words, as you might imagine, is just the crowd plus the sourcing part of that word, and then same thing right here, crowdfunding. Both of those terms apparently first known use is around 2006. So you can imagine if they were just using the term in 2006, this thing didn't really get started, really involved until here in recent years. All right, so here's a kind of a good definition of what crowdsourcing is. So it's the process of obtaining needed services, ideas, or content, any of those things, by soliciting contributions from a large group of people, especially from an online community, rather than traditional sources there. So as you may know, maybe you might have been involved with this, is that the first kind of foray into crowdsourcing was open source programming. So many of you may use the products that are generated from that, right? From Firefox or the different softwares that have developed as an open source. And the idea there was by opening up to other programmers, people were allowed to fix it, modify it, clean it up, and improve the code. And instead of a proprietary code, we won't have competitors, but really compatriots to make a better product, right? So that was kind of the idea. Started there, and then as that idea kind of developed, it's like, well, if we can do that to get things accomplished, like coding and technology products, maybe we can use the same kind of concept to fund projects, right? So crowdfunding came about, and so your definition of crowdfunding is right there. Practice of funding a project or venture by raising monetary contributions from a large number of people, typically via the internet, right? So typically you're going to be raising small amounts of money from each one of these large people, so that hopefully it adds up to a large amount of dollars there. All right. So we've talked about that it's one word. So which word is it? Is it crowdfunding or crowdsourcing? Right. So turns out crowdfunding is a type of crowdsourcing. Right. So crowdsourcing just refers to that you're needing some kind of you're appealing to the crowd to get something done. When that something to be done is financing, they call that crowdfunding. Right. So henceforth, we're only going to be using the term crowdfunding. Right. So another way to so what are some different ways to think about crowdfunding? So what we're going to learn is that it's really not a new idea. It's kind of old ideas, kind of packaged in new ways. Right? So much of life is like that, right? So crowdfunding is a type of microfinance or micro lending in the case of debt. So when you hear this term microfinance, what does that mean? You hear what's that? Individual projects.
So like small.
Probably smaller, right? So when we talk about microfinance, we're usually talking about smaller individual projects that basically you're not totally cut off from other sources, but based on the scale of your project, you're probably not a good fit for the big banks or from this lender or that lender. Okay. So usually we're talking about kind of smaller scale. How about peer-to-peer? You've heard that before. Peer-to-peer financing. What'd you say that would be? Yeah, just people people like you, just kind of going to your peers and trying to seek financing amongst yourselves. Again, not using an intermediary, not using a bank, not using these different things, just kind of just going to your peeps, as it were. How about syndication? Right, so it's said that crowdfunding is much like old-style syndication with the power of the internet behind it. So what's a crime syndicate? It's like a gang, this is a group, right? And so real estate syndication is basically when you would get funding from a group of investors, right? It could be the good old boys at the country club. It could be your pals from college, but typically it's a small group that they're usually going to be putting up bigger amounts of money. Right, so that's kind of what we're talking about syndication, a group of investors there. So it's kind of like that, except for we're going to use a lot more friends, and a lot of these will not be friends, and we're probably going to get smaller contributions. So, but that's kind of a good way to think about it. It's kind of old school syndication, getting funding from a group. We're increasing our group size. All right. Also, it's a little bit like a private placement, except with many investors. So, you might know what a private placement is. Like in the securities world, if a company needs new shares, what might they do? Yeah, if they need to issue some new shares, if a public company needs to issue new shares, what might they do? Instead of having the another seasoned equity offering out on the market, what might they do? A little bit close to that. They might go to, what's that? Yeah, they're going to use a private placement. They're going to go to certain wealthy individuals. Hey, I know you kind of like, our company, you have a small position. We're looking to build, to issue some new equity. We'll issue you new shares at such and such price. And they'll have a private negotiation with that one or two investors and place those new shares privately. It's a little bit like that. Yeah, it just typically it'd be common, but I guess you probably could do that with preferred as well. Yeah. So you can imagine there has to be benefits on both sides. So for the company, maybe you don't have the underwriting fees, you don't have to pay the investment bank to help you float this deal and stuff like that. You're saving on transaction costs, and maybe you can pass those savings along to your investor at you can agree on whatever share price you want to, right? So he can be buying at a slight discount in order to compensate him for. Yeah. So if you hear anybody saying, talking about bragging about how they just bought out a private placement, they're probably pretty wealthy because the company wants to move a bunch of shares. All right, so it's a little bit like that. So kind of like we said here, that's probably a great way to think about it. Modern repackaging of old ideas enabled by technology, number one, and number two, deregulation. Right. So the reason why this is coming to our front right now is because A, we have to have the technology to do it, but we're also starting to get some deregulation. Now, I'm going to go ahead and tell you, my bias is against regulation. My bias is towards freedom and towards liberty. So you always have to, sometimes I get overzealous in the crowdfunding stuff, particularly when we talk about the Jobs Act and how it's heralded as a major new advancement. It's like, well, hell, it's just the government getting out of the way. So now that you know which way I'm biased, you can interpret my comments and accordingly and adjust for said bias. Okay. So just give you some ideas about crowdfunding globally. This thing is just barely started, right? And so they say between 2012 and 2013, it's almost doubled to 5.1 billion. The estimates are just exponential growth right now. And it shows you who made that prediction there. The most important component accelerating the growth of crowdfunding is deregulation. So, like we said, so the Jobs Act was finalized. All the rules and stuff like that were finalized just last year. So we're not talking about something that's very old here. Okay, any questions about that? To tell you, give me an idea about, so anytime you see text like this is because I've just copied from their thesis, right? But we've already talked about how this is kind of a repackaging of old ideas. Well, just how old are some of these ideas? If you look down to the second paragraph, concepts relating to microloans can be found as early as the fourth century, when the first private credit union called anybody want to take a stab at that? Lun Hui was founded in China. In the West, the concept resurfaced in the 1740s. Talks about how 3 different loan funds, 18 to 40. So we're talking about old ideas, but the websites back then were ways too slow, right? So investors didn't really like that type of thing. So it took a while for technology to catch up, and then this is a good time, a good blend of technology and then an environment of deregulation. Give you an idea of how recent of a term crowdfunding is, how recent of a topic this is. This kind of gives you a chart of the Google search volume for crowdfunding, for the term crowdfunding. And so this is just an index where 100 represents the peak measure there. You see it really doesn't even start lifting off the ground until about 2010. And then relative to how much it was being searched for in 2013, even just a year prior to that, 2012, it's like half of that. So we're really talking about a new subject here, kind of a new phenomenon. I would say brand new. I'd say maybe the first floors. We're not getting out of the ground, but we're maybe on the first floors. All right, this was some interesting pie charts from their thesis to asking the MIT MSRE alumni, right? So a very specialized targeted group with real estate. How familiar, or did you know what crowdfunding was prior to they sent them on these questionnaires. Prior to that questionnaire, how many did you know? And so the yes, 79%, and so the red being 17%. I think that's the non-respondents there. Have you heard of Kickstarter? Most of them said yes. These other websites you see there. So when we look at just the real estate oriented sites, have you heard of FriendRise? 82% said no. Collabority, 95% no. Realty Mogul, mostly no. Right? So again, this isn't just Joe Sixpack out there. These are people, in the industry, maybe potentially old. We don't know how old their alumni are, but probably all kind of different ages. But again, we're talking about, and this thesis was just done last year, I think. So we're talking about, again, very new subject here. So who are the three primary actors, the three primary components in this crowdfunding? So you have one, the project initiator. All right, so this is the person with the idea, with the proposal, with the investment. Two, you have the investors. All right, so you have the initiator, the investors, and then thirdly, you have the platform, which brings those two together. Right. So one of the great things, the reason that technology is needed is that you may have a great idea, but you may not be able to, prior to the internet, you may not have been made it known, right? At least on a very cost-efficient basis. But now that there's the internet, those two groups can find each other a lot easier through this platform. And by the way, there's some really interesting stuff going on at the platform level. We're going to talk about that tonight, but there's some really, really interesting stuff going on here. Right now, you're just kind of thinking that there's a website, right? But we'll shatter that myth or that misconception before the night's over. This is some really interesting stuff here. Just to give you an idea about some of the general crowdfunding sites. If you're talking about donation, those are two. A reward, like we talked about, Kickstarter. Pre-order, get the Pebble device. I don't know if you remember that one. But that was like one of the first pre-order projects that really took off. Lending, you might have heard about those websites on the lending side. So this is when you're on the debt side of things. Equity. Here's some other ones. Right. On the real estate side of crowdfunding, sites tend to be specialized based on residential or commercial. They can be specialized on large versus small projects, debt versus equity. So remember last time, or one time we talked about the different opportunities in real estate, right? The different types of investments, value add, development, core plus, all those stuff things. So some of these are kind of aligned along with those. And in regards to the leading real estate websites, these are they. Right. So, James, you were talking about hold periods, and so what kind of a holding period are the investors potentially could come in with? It turns out that according to Crowdfunder Insider, you can see that, they said that with debt, the hold periods tend to be very short. It ranges from 6 to 18 months. Seems really short, right? I'm thinking maybe that's like bridge loan type things, maybe flipping houses type things, because that's barely even started amortizing right before it's due. So I think that's kind of specialty. Equity varies more widely from, say, 6 months in the low end to up to 10 years in some instances. In either case, you're going to be signing up for probably a commitment, almost like in the JV agreement, where you're making your investment and then say, okay, this is our projected hold period. How easy is that you could break out of that? Probably not. I think once you make your purchase, make your investment, you're probably locked in at that point. The good thing about the crowdfunding is that they wouldn't be coming back for you for more, right? They may issue, say maybe they go out and raise $10 million for your crowdfunding and you bought a $10,000 share into that. They're not going to come back and say, oh, James, we really need $20 million. So they're not going to say, hey, can you kick in some more? They might open up maybe another round of investing, but they're not going to come back to you for more money. Right. The hold periods, like I said, they say vary, and that will be in the prospectus about what kind of hold they're talking about there. It seems like a lot of these things are kind of shorter duration, that they're taking, like they're doing some value add on the property, or they're doing some development or something like that. Most of it, just from scouring around the internet, it seems like most of these are value add, that they're doing some redevelopment, some kind of shorter hold periods. Okay. Questions up to this point? Any that are not open to non-accredited? Yes, and we'll talk about that. Yeah. So the accredited, non-accredited investor is a huge topic. So you're right on the money there. And really, to a lot of people, and I would agree with this, you're really not crowdfunding until you start letting the non-accredited investors in. The crowd isn't an accredited investor. That's not the typical person. So, but that, particularly with the Jobs Act, that was aimed at kind of relaxing some of those regulations. Okay, so kind of what we talked about earlier is, okay, what's the analogy to REITs? If we have REITs, then why do we need crowdfunding? And so, as we'll learn, let's see, I guess next week, right? I think is when we're covering REITs. REITs were established back in 1960. So, even REITs aren't very, very old, right? And so the whole goal of REITs was to allow investors the opportunity to invest in large-scale, diversified portfolio of income-producing real estate. And the reason why this came about, there's some studies, modern portfolio theory and things like that said, hey, real estate is less correlated with the stock market. There are some benefits of owning real estate. It's less volatile as well. And so that kind of opened the door of, okay, creating these REIT vehicles in order for small-scale investors to participate, not just your fat cats. REIT offers a liquid way to own fractional ownership in these buildings. So, if you look out the window and see these tall office buildings, typically before REITs, if you wanted to own some of this, you might have to go into a joint venture or something like that, having very huge investments. With REITs, now you can buy a share of REIT for $10 and own a slice of a bunch of different properties. So crowdfunding is similar, but it's at the asset level and not nearly as liquid, right? One of the things we're talking about a very young industry. As soon as you start talking about liquidity, in my mind, you start talking about a secondary market, right? I've bought into this project, and it's going well, it's like that, but I might want to get, maybe your plans have changed. You're going to buy a new home now. You'd really like to have that principal back. It'd be nice if there's a secondary market you could show that into. To my knowledge, that does not exist yet, a secondary market. Do I think there will be one day? I do think so. All right, so at the end of this, we're going to start talking about maybe some crazy ideas about where this thing could go to. So you start thinking about secondary market, you start talking about securitizations, maybe you start talking about some derivatives that are based on this, maybe you start thinking of mutual funds, of crowdfunding deals. It seems like there's a huge amount of opportunity here for some new ideas. All right, so I think we kind of covered this earlier, but the whole idea is that with REITs, why crowdfunding is because, again, REITs act more like small cap income stocks than direct investments in real estate, meaning that they're going to be higher correlated with the overall S&P 500. That's why some folks, some of the your wealthy individuals, that's why they love the direct investment in real estate. It's because it has that less correlation. Now, I wouldn't say you probably can't say it's totally uncorrelated, because if you own an office building, obviously if your office tenants are, their stock gets pummeled, that might affect you in some way, but it's certainly going to be a lot less correlated, right? So that's what we want. We start talking about being a diversified investor. We want to have assets that aren't correlated with each other so that they all don't go down at the same time. Direct debt is probably even less correlated than the equity. However, it can be difficult to invest directly, right? So large institutional investors have kind of bifurcated the markets, kind of split the market in two, leaving the average investor unable to gain exposure to hard commercial estate assets. So basically, we're saying that yes, direct ownership, direct investment has benefits, but it's really hard for the average investor to do that, right? REITs were set up to be like to offer that, but they have this correlation with the stock market. So it's still really hard for us, for just normal investors, to kind of participate in some of these projects. And so we kind of have what we called, the authors call a sub-institutional sector, where you have folks that maybe want to own investment real estate directly, but they can't because their pool of money isn't big, or they don't know the right they don't have the right connections to, to participate in that. And so crowdfunding kind of fills that goal, kind of fills that niche, fills that need. So, don't walk away from this lesson thinking that crowdfunding is the solution to everybody's funding needs. That's certainly not the case. There's going to be probably more efficient, easier ways. If you can just get a first, if you're just blowing and going, and you can get a first mortgage, and then your friends and family can contribute the other equity, you probably don't need this. But if you are a small scale, if you are a new guy, if you're new to the business, if any of those things, it's possible that crowdfunding might get you to the level where you're going to those more traditional sources eventually. Right? But as an investor, on the other side, flipping the coin there, instead of maybe being a demander of capital, maybe it's as a supplier, you might consider some of these investments because, number one, it might be in your backyard, right? And you really know, like you guys were saying about that shopping center. You might say, oh yeah, that's I can't believe that's up for refinancing. That's really solid. It's packed all the time. So having familiarity with the asset would certainly help. And also, I like it in that most of these chunks, most of these investments are small scale, right? Some of these projects are going, as low. I've seen them go down to as low as like $500. It's like $500. I just, that's almost that's a few fancy textbooks, right? And so I think the smaller scale will. I really like crowdfunding in that the smaller scale of it maybe will draw in participants that might otherwise have been, afraid because of losing so much money. Maybe if you're talking about 1,000 or 5,000, that's not as serious, but it could potentially get someone, kind of interested in real estate. Right. So there's a lot of thought out there that says crowdfunding improves matching. And what we're talking about with matching, I'll come back to that one. But so this is a survey that was done with the MIT MSRE alumni. And so they were asked the question, rate how difficult it is to find new qualified investors for your real estate deals. And this is the very difficult side, and that's the very easy side. So most of them were lining up on that, hey, it's pretty difficult for me to find investors, for qualified investors, for meaning that they can actually do it, right? And actually fund it for your new real estate deals. And then down here, the question was to the how difficult is it to find new qualified investment opportunities to the investors? And again, most of them lined up on that it's very hard, right? So if these two groups are finding it hard to find each other, it seems like something like crowdfunding, where this online platform where deals can get posted and investors can know that there's a handful of sites that they can go to look over these deals, it seems like there's going to be an improving matching process going on there between investments and investors, right? Your thoughts on that? Maybe we find there's a new type of broker that emerges, a crowdfunding broker, and matches up these two sides. The possibilities with crowdfunding really are limitless, and the exciting thing is that this is happening when you guys are still young enough that you could potentially hop on to this trend. Yeah, Paul. All of these answers are coming from these folks right here, from the MIT MSRE alumni. Yeah. So again, they could be of all ages, but they have a master's degree in real estate from MIT. So they're imagine they're pretty well connected, but that surprised me. And it probably surprised the authors as well. So, sometimes maybe we run in separate, we run in separate circles, and maybe sometimes they have excess capital that they'd love to put to use, but they just haven't been pitched the good ideas. Maybe they run around in circles where they get all the bad pitches. I don't know. But that's really interesting. But I'm trying to think of the book. Outliers. Have you guys read the book Outliers? This reminds me of the Outliers, and they talk about how, like, some of the greats in industry, they are all, when there is a major change, technological innovation or regulatory innovation, they are all around like late 20s. All of them. When you go back and look at it in history, all the heavyweights. So it's like you have to be young enough to we have the energy to take advantage, but you also have to have this major change that you can jump into. I thought that was really interesting. All right. So, all right, with banks, why crowdfund? Well, again, your scale of your project just might not be large enough, right? So back when I was doing commercial lending, is like, if it's not $1 million, it's not even, we can't even pick up the phone. So again, crowdfunding is not for everybody, but it could be that because of your scale of your project, it's not large enough. It could be that maybe it's large enough, but because the cost of capital is just so high, maybe it's not worth it. Like we said, it's going to improve matching. Disadvantage with crowdfunding versus banks and other sources, in some cases, it's speed, right? The speed in order to raise that money. So if we saw those investments that are open for continuing investment, how long will it take them to meet their goal? Maybe a short time, maybe a long time. So there's a little bit of uncertainty of that. There are some sites, and this is going ahead and cover some of the stuff we'll mention later. There is an investment banking model, a platform, where the crowdfunding site, they go ahead and they pre-fund the deal. So James is looking for $5 million. He comes to, I think Fundrise actually does this. He goes to Fundrise and looking for crowdfunding. It's possible if Fundrise really believes in the deal, they'll go ahead and front James the money, the $5 million, then sell the crowdfunding shares behind that. Right. So that meets his need of needing to be able to close, but it also gets him to be able to raise the money from the crown. Investment returns. Typically, accredited investors, and again, we'll talk about how that's been relaxed, can buy into projects from $5,000 to $10,000 a share. That's kind of a typical range. Like I said, I've seen it down to $1,000, down to $500 before. At $500, it was a small scale. It was like a flipping a house, like a $300,000 house. Typical returns range from 5 to in excess of 13%, depending on the type of the deal. And again, this is coming from my source down here at the bottom there. Crowdfunding is definitely an idea whose time has come, and you always want to emphasize to you, and particularly this is true of much of life, but particularly with real estate, that timing is everything. And those of you that have had my classes before, know the kind of thing I always like to say is, what's the difference between salad and garbage? It's time, right? You can be looking at the best salad in the world, but give enough time and it's absolute garbage, right? So it could be that you want to do something, but the timing just isn't right. So sometimes the timing of what you do is more important than what you do. What's that? Absolutely. Right. And vice versa, right? The hot spot now, things collapse, so a lot of things, and if we could have a better idea about advice about timing, then, you can make a ton of money, but This is a good illustration of this. So again, Ben Miller, the co-founder of Fundrise, he goes up to Larry Silverstein, big time financier, and pitching his idea about his crowdfunding website. And Silverstein says, "Yeah, that sounds great. Let us know how that goes." Basically saying no. 3 years later, they maintain their relationship, and then Silverstein kicks in $31 million, along with some others, for the first round of funding for that website. So you're told no initially, but maintaining the relationship, sometimes it just ideas kind of grow on folks, right? So I thought that was a really interesting story that he shared. Here's another person who's kind of got the crowdfunding bug. So there's this attorney. Said that he thought this would be the most transformative legal change in my lifetime. So I decided to make my business, get involved, and learn. So he kind of stopped what he was doing, and kind of is now towards this. And there's plenty for him to do because there's so much legislation involved with these things. It's crazy. Right? So questions up to this point? All right, so we're going to talk just as much as we need to about the laws and regulations. You could really, jump into the deep end of this pool really quickly. We're not going to do so. We're just going to kind of skim the surface and kind of let you know why deregulation was needed, and then so that also what type of investors these certain regulations allow. So as we've already, Peter's already kind of questioned is, are there some sites that allow non-accredited investors? And so some of the regulations allow for that, and it'll help you understand what you might be looking at as a potential investor. All right. So the reason why this is such a big deal is because from a legal perspective, the sale of equity in exchange for future compensation or issuing debt with an attached coupon of interest payment represents the sale of a security. All right. And therefore subject to SEC regulations. So that's why Kickstarter kind of, they have a thing more of a thing is a reward. You make this donation and you get this reward. So they're doing that to get around this, right? So several early crowdfund entrants, such as some of these, I don't know if you know any of these, saw any of these. I think BioBeer, that was a crowdfunding attempt to buy, Pabst Blue Ribbon, or the Pabst Brewery. I think that's what that was. So these sites, they just basically ignored these laws. SEC, that doesn't apply to us, and just went ahead and basically were engaged in crowdfunding without addressing any of the regulations imposed by the SEC. And so SEC came down and said that you since you're not registered, your securities aren't registered, and you're not a broker-dealer. They were issued cease and desist orders by the SEC. Only Prosper.com survived their interaction with the SEC. All the other ones were shut down. All right, so this is a interesting little topic on that in regards to what happened to ProFounder. So a brief period of time, ProFounder was the industry leader in crowdfunding. They provided a regulatory wake-up call to the crowdfunding industry and some instruction regarding the future of the relationship with the SEC. The firm was founded by this other site's co-founder, Jessica Jackley, and fellow Stanford Business School classmate Dan Amarillo. So these people, well educated, they just decided to thumb their noses up at the law. So they allowed both accredited and unaccredited investors to invest in different equity classes of startup businesses. Their business model was for-profit. They charged a 5% transaction fee on capital raised. That would make them a broker-dealer, right? Their securities would make them, those securities needed to be registered, potentially. So while they amended their business model to accept only accredited investors, they still raised capital for third parties, charging a transactional based fee. Either criterion was enough for regulators to view them as broker-dealer. The state of California issued a cease and desist order per co-founder, and leading to their eventual closure in 2012. Right, so this stuff is pretty serious. So don't go out and create a rogue site that you're just going to fall out underneath the radar. Eventually, it is going to catch up with you. Here's some of the major regulations revolving securities that kind of led us up to the point that we are now. Everything started off with the Securities Act of 1993 and kind of leading up to recent times of the jumpstart our business started, so other known as the Jobs Act. Right, so it says 2012, wasn't really pieced all together, fully fleshed out until I believe last year. Right. Interesting thing to note on here, each one of these followed a financial disaster. Just FYI. Except for probably one of the best ideas is the Reinvestment Act of 1960. All right, so as many times we're kind of, I've already told you where my bias was, right? And so a lot of times, sometimes the cure is worse than the disease. It can be sometimes. And so what's happening now is that a lot of this stuff was kind of set. You see the dates, 30s, 40s, 60s. Now with the intervention of the internet, maybe some of these, it's time to change some of these regulations, and that's kind of what the Jobs Act kind of addresses in some part. So again, like we said, that the kind of Securities Act kind of starts it all. So this is kind of the important part that you need to know about the Securities Act of 1933. That under the regulations, all securities sold in the U.S. fall into one of two categories. Right? You're either registered or exempt from registration. When to register securities, the company has to do all these things. So think of like an initial public offering. There's all these laws, regulations, filings, certified financials, all this stuff. Very, very expensive, right, to register your securities. Or you qualify for one of the exemptions where you don't have to do those things, right? And so this is kind of the space that crowdfunding plays in here. So if you meet certain regulations, if you're under this many size, if you meet their requirements, you can possibly qualify for one of their exemptions. Okay, so everybody kind of set the scene. So the Securities Act of 33 sets up two types of securities: registered and exempt from registration. Crowdfunding is going to follow on it because it's so. Remember, we're typically going to be raising a very small amount of money. When I say small, not small as in trivial, but relative to like an IPO. We're not raising billions or millions of dollars, right? So we probably aren't going to, from what I'm told, is like, to like take a company public, you're talking about $1 million before this first share is even, before the first share is even sold. So $1 million is just out the door. So, if your project's $2 million, that's probably not going to fly, right? All right, so we basically have two flavors of exemptions. What was known as Reg D or Regulation D and Regulation A. Right, so now you kind of, if you remember those from the objectives about kind of knowing about a little bit about Reg D, Reg A, and the Jobs Act. So we're talking about Reg A, Reg D. These are again in reference to the 33 Act and amendments to the 33 Act. So I have 2 pages of summaries here of exemptions. This is a file that I put together, and basically everything, so there's a black line right there. Everything this way is old. Okay, so this is going back to the Securities Act of 33. So you have Reg A, and then you have 3 flavors of Reg D, Rule 504, 505, 506B. You don't have to worry about that, right? You don't have to worry about all those flavors. Basically, we can just kind of summarize what's happening, what was the deal with Reg A, Reg D, and then what's happening now. So what's happening now is best going to be summarized in the next slide. All right, so we'll just say now, we'll just say kind of see next slide, but because when this was done, they're only considering one new change, but they actually came out with 2 different tiers of this. All right, so this part's kind of a little bit dated. All right, so you see how, just taking a look at it. So if you just take say Reg A and any of the Reg Ds, but really this is the Reg D that it says traditional Reg D. This is kind of the one you'd focus on. So that one and this one. Right? Any major differences that you see? Wow. Reg A allowed for, there was no restrictions on who your investors could be. The other one's mostly is accredited. This one was also no restrictions, that flavor of Reg D, but Reg A versus the traditional Reg D, wow. Reg A seems kind of nice, right? Max offering size, 5 million there, 1 million there, but there's no limit over here. Solicitation has to do with, okay, how can you advertise? Can you contact these potential investors directly, or not? Or can you just do it generally? Restricted shares has to do about what's these, are we restricted from selling these for a certain amount of time? Certified audited financial just means, does the company, the company have to provide those? Here's the big one. Blue sky laws apply. Right, so that's kind of our concern. That's kind of our concern. And that's the big concern. Right. With Reg A, the blue sky laws do apply. With Reg D, they do not apply. Anybody have any idea what blue sky laws are? Right. Let me skip this one, and then we'll come back to it. All right. So every state has its own security laws, known as blue sky laws. So that's what blue sky laws are. They're state security laws. Right. They're designed to protect investors against fraudulent sales practices and activities. While these laws can vary from state to state, there are some similarities. Where is it? Essentially, this means that there are 50 more security regulators in addition to the SEC with which issuers would have to comply with in order to access capital on a national level, unless the offering is done under Regulation D. Right? So remember, blue sky laws apply to Reg A. No restriction on eligibility. Hey, that's great. Let's go issue some securities. Oh, I have to go and issue securities in every state that I want to sell into. Potentially, if I wanted to go nationwide, I'd have to file with it with each one of these states, whose requirements vary. It gets very, very expensive. Reg A is not a whole lot of use. All right. So then, most the crowdfunding that's been done up to now has been done under Regulation D. So those blue sky laws do not apply here, but you're restricted to accredited investors. And that kind of set up the environment that most of you know about, and then what Peter was mentioning, that most of these creds, I went around last night trying to look at some deals, and all of them want you to register and indicate whether you're an accredited investor or not. It's like, geez, I just want to take a look at them. All right. So Reg A, no restriction on investors. Blue sky laws apply. Reg D, accredited only, but you don't have to register with any of the states. So what did the recent legislation do? What did the Jobs Act get done? So this is, the main action is really here. Reg A, what they call Tier 1, Tier 2. As the note says down here at the bottom of your notes here, that's also called, the nickname of it is Reg A+. Right? And so this isn't something I created. I found it and I was very thankful for running into it. And so if you follow the link, it takes you to the full document. And again, the only thing that we kind of are interested here is what type of investors can be there, and then if the blue sky laws apply. So notice that there's different limits on here. So Tier 1, $20 million raise for a security, $50 million on Tier 2. There's no individual investor limits there. For Tier 2, all offerings, so $2,000 is anybody can buy up to $2,000, right? No status, like it says down here, investor verification, self-certification. You're basically checking a box that, I know what I'm doing, that type of thing. So anybody can buy up to $2,000, right? If you can buy up to 5% of your income if your net worth is below $100,000, and then you can buy shares up to 10% of your income above $100,000. Make sense? So kind of depending on your wealth, they'll allow you to buy more securities. Still, trying to protect. The basic idea is that if you don't have a lot of money, that you're not a sophisticated investor, that this is too risky for you. As you have more wealth, you're supposed to know what you're doing. Again, you're supposed to, but many of us do not. So the investor verification, when it says self-certification, basically it's just like you said, it's almost like stated income. Right? This is what I make. This is what, yes, I check this box. There's no third party. I'm going to go behind and check that. State preemption. We see that Tier 1 says no, Tier 2 says yes. So we do see some difference there. $50 million for Tier 2. It preempts the states. So in this case, state preemption, and it says yes, that means the law preempts the state's ability to make them require them to file in their state. So this is what you would want. You want it to be that they do preempt the state's rights there. So yes, here it says no, but there's offered a coordinated review. Coordinated review is kind of like this grouping together of states that says, okay, we all have our laws. It's really hard to comply with all of our laws, so we're going to get together and try to have a common set of laws among this group of states. That's kind of what coordinated review is. It sounds good. It sounds very hopeful, but everything I've read, the participants, Ben Miller at Fundrise, doesn't have much faith in this. So I'm not sure about why that is, but so there you are. So to go back to answer the question, when you run into a crowdfunding site, it could be that if they're only going to allow only allow you to participate if you're an accredited investor, it could be that they're set up, that at least that issuance is set up as a Reg D offering, and they can't do anything about it. Right? Newer offerings could be, and I think this is at the offering level. This is not at the site level, so it's not just a crowdfunding platform type thing. It's just this particular deal. Newer deals may come in under Tier 1 or Tier 2, and you could participate, depending on what your net worth is, up to that level. Right. Does that make sense to everybody? So it could be on a particular site, this deal is only for accredited one, this one's not. It all has to do with them trying to, based on which which exemption. So again, think of this Reg A, Reg D. These are exemptions to the registration requirement. Okay. Any comments about that? Is that clear to everybody? And that's all about the only regulation that we need to go into, right? Like I said, it gets deep really, really fast. So I prefer not to get into that minutia. In case you're interested, why are the state laws, security laws, called blue sky laws? I looked into this actually because I was wondering myself. It seems like the first time it was used in 1917. And it comes back to that the only thing that it can come back to is really a quote that someone said, the names given to a law indicates the evil at which it is aimed, that is, to use the language of a cited case, speculative schemes which have no more basis than so many feet of blue sky. And from that quote, that slang term kind of held. Seems kind of weird, but whatever. All right. Everybody understand? Everybody good with that? So you see legislation, you see regulation creeping up time and time again, and a company or a project, they would like to issue securities or issue, potential opportunities, but because of various regulations, it makes it more difficult. So the job that came in started loosening some of those regulations. Like I said, it was heralded as something tremendous, but at the same time, it's really just the government getting out of the way a little bit more. Okay. If you're interested in what an accredited investor is, it's defined in Reg D as the following, and these first ones here usually apply to an entity. So like if you're a bank, any of these things, charitable organization, director, business, if you all the accredited investors. We typically, you and I, individual investors don't follow on these criteria. We qualify under, usually under 6 or 7. So you have an individual net worth or a joint net worth with a person's spouse that exceeds $1 million at the time of purchase, excluding the value of the primary residence. Or if your income exceeds $200,000 in each of the 2 most recent 3 years of your income, or if you have a spouse and that income exceeds $300,000 for the last 2 years, and you have a reasonable expectation of that same income level in the current future. Okay. Or does the 6 and 7 sound like Joe six-pack investor out there walking around? Not hardly, right? And so there's a lot of people saying that, hey, one of the things that could really help with this crowdfunding thing, they were hoping that they were going to revise the definitions of accredited investors to allow for maybe some kind of educational requirement or attainment feature, maybe lowering those thresholds, but they left them where they were. All right, so the accredited investor is how it is. You see it there. Let's see. I think it's a little bit later. A little bit later, we'll talk about what's known as a qualified investor. All right. So, if you're not an accredited investor, how could you participate? You could be looking at a new deal that was formed under, a Reg A plus, either Tier 1, Tier 2. Here's another one. All right. Here's another different one. So some state laws enable portals to market and to accept investments from non-accredited investors as long as both the investment and the investors are in that same state. So I know that this is the case in Georgia. And so there's a website, CrowdVested in Georgia, and the minimum is $500 to give local people to invest locally. Lots of potential benefits to this. Proper owners can show that there's community support for development. Ultimately, the development funds to local pockets. It's really exciting. So one of the models that they talked about with this is that think of a multi-tenant shopping center, retail center, or even an office building that was crowdfunded through something like this, right? And then it's full of businesses who got their equity, startup equity, through crowdfunding. And the retailer at the retail, maybe the people shopping there at the retail center are the investors who help fund that retail center, and they're helping to support them through your expenditure. So it's kind of interesting, at least kind of pie in the sky ideal, but it's pretty cool though, right? It's within reach. Again, we're talking about stuff that's very, very young. Okay. And as this guy says, real estate is an ideal place for crowdfunding. It's tangible, you can touch it, surrounded by metrics. Ultimately, it's easier to explain than a software patent. So I absolutely agree with that. The real estate assets are the perfect assets to lend against and borrow against because of all those reasons. All right. This is about the Jobs Act. Again, game changer. Let's get out of the way. Won't go into all this, but Title III of the Jobs Act formally introduced the term crowdfunding into the securities law lexicon. Right, so crowdfunding, that's actually a thing. Right? It was just kind of a slang term. Now it's actually in securities law. If you're interested in knowing exactly kind of what it does, this is kind of a summary there, and then it has some of the major, I think 3 or 4 of the major points of it. But the gist of it, the importance of it, is we've kind of already covered. You're allowing more types of investors to invest. All right. So there was a new term that was introduced, a qualified purchaser. And in respect to Regulation D offerings, the qualified purchaser equals an accredited investor. Great. Another term for the same thing, right? But in the recent legislation, in terms for the new Reg A, the Reg A Plus offerings, a qualified purchaser is all offerees and purchasers that qualify for a Reg A Tier 2 offering. So this is where anybody can invest up to $2,000, all those type of things. So as long as you're meeting whatever the wealth or income restrictions are for those securities, you'd be what's known as a qualified purchaser. Okay. As accordance with Reg A Tier 2. All right. So that's that's kind of a summary of how you can invest as a non-accredited investor. Either it's a state thing, like you saw, with Georgia, or it's a new deal going through either Reg A Tier 1, Tier 2, and you're meeting the requirements on this. Right. So again, if you go to a site, if you go to one of these funding platforms, and some deals are still accredited, that's how they were registered. That's how they're set up. If not, some of the newer deals, maybe they follow these new types. Right. Any questions at that point? I mean, I would love to. I hope these deals. I would love to spread money around and on a smaller scale, and $500 or $1,000 to invest in a whole portfolio of projects around town that you believe in that area or this project. That'd be pretty cool. I think be able to check up on it and ride by it, knowing that you're helping to, get that project off the ground. You're earning a good return. That I just think that's really attractive. So everything doesn't have to be skyscrapers and huge scale projects to be exciting or even fun. All right. So we talked about the investors, and so now we're kind of going back around to talking about the funding portals. All right. So when we talk about funding portals, it's the same thing as funding platforms. It's the same thing as saying the website. All right. So Fundrise, Realty Mogul, all those things. We're talking about the portal, right, or the platform. Okay. The technical term, I guess, is the funding portal. That's how it's defined in the law, in the Securities the Jobs Act, which modifies the Securities Act. Right? So a funding portal does not do the following. Right? So funding portal does not do all these things. They're not going to give investment advice and recommendations. They're not going to solicit purchases, sales, offers to buy the securities offered or displayed on its website or portal. Compensate employees, agents for such solicitation based on the sales of securities, hold, manage, possess, or otherwise handle investor funds, engage in such activities that the commission deems appropriate. Right. So basically, the big thing here is that the funding portal is going to, we're going to see in a slide or two, the things that they are required to do. Basically, they're going to be a pass-through for information. The sponsor, the developer, flows information through the website to push it to investors. The investors can push information back the other way, funds back the other way, and the platform is kind of agnostic. You know, it's not going to, they're not going to get commission for it, and they're not going to counsel you on whether this is a good investment or not. It's just basically going to provide you information. All right. This is just kind of some background information about kind of how they're set up on the back end there. We can just kind of skip on that, but again, they're not going to advise anybody about due diligence, and they're not going to take a commission. All right, so they're required to assist and protect investors from fraud committed by issuers by taking the following actions. So all these different things. Okay. So they do have certain rights and roles and responsibilities of things that they have to do, and then there's some things that they're forbidden from. All right. Any questions about those? So this is kind of getting, again, talking about kind of this investment banking type mode of a portal. So although the portal cannot receive commission, which restricts their profitability, the portal or platform is permitted to co-invest in the project, in the securities offered for the sale. Furthermore, the section allows those who provide auxiliary services such as lawyers and accountants to bring investors to the intermediary without registering as broker-dealer. So it could be that the portal, they're taking on part of the investment themselves, right? So they're hosting the deal, and you see that, okay, maybe 2 million of the 5 million has already been met. It could be that they're part of the 2 million. More just kind of things that you're supposed to do. Here's a list of the top 20 of all types of crowdfunding sites by their U.S. rank. Most of these, all of these are not real estate oriented, but probably those are some names that you do recognize. Kickstarter being the top one on this list. Top 10 real estate at the time that they did their thesis, you see there. You see Fundrise a lot around on the internet. They're probably growing very quickly. This is some more results from the MIT Emissary alumni, and they were asking those surveyed what's the most important portal qualities from their perspective. And you see what their feedback was. Deal sponsor track record. Right? Always important. Your reputation in real estate is always important. You see all these other things, and then going down to the last one, ease of investing electronically. I would have thought number 6 would have been a little bit higher, but it just gives you some kind of an idea about what people are kind of expecting from these portals. All right, so now let's talk. I told you before about these portals. It seem like they're just boring. There's information passed through, stuff like that, and they're not very exciting. We can start talking about some of the exciting innovations in this topic. Let's talk about developer portals. So how should developers and property owners approach crowdfunding as a new source of capital? One potential idea that's come about is that basically developers could become portals themselves. So they could have a deal flow, and they have the deal flow in investors, put the deals online, and create it from existing deal flow. So basically what it's saying is, if you're a developer and you got all these projects going on, instead of going out and getting capital, from external providers, stuff like that, if you have this deal flow, maybe you create your own portal for your own deals where you're generating the money and handling it through that. That's pretty cool. Yeah, it would be. And then, so that kind of brings up Groundbreaker. And what Groundbreaker basically does is they're like a portal provider where you get your own sandbox with full control of your web-based portal. And they basically provide all the technology for it, and you just kind of design it the way that you want it. This is why I'm saying that the innovations and the possibilities in this space is just really, really exciting about the potential possibilities there. So I agree. They can't just do it themselves, but because of something like this, and maybe there could be consultants who kind of help them navigate the process as well. But if they can raise capital on a routine basis, cheaper than what there are now, something like this might make sense. And then this is the investment banking model. So while the platform enjoyed early success, the fact that sponsors didn't know whether they'd raise the cash at all or know when they'd finally get it all was a drawback. And so now what's happening is some deep pocket institutions, they're basically, so like the example on the slide we saw from Fundrise, they got a $31 million injection. That $31 million is used to go ahead and pre-fund deals, right? So they're going to fund the transactions up front and then turn around and offer a stake in the deals to investors online. What do you think about that? And so here's a quote from Ben Miller. We've gone toward a business model that's more like investment banking as opposed to a pure technology platform. It's been the biggest fundamental shift in our growth. Let's see. Yeah. So they've arranged 16 million. I know 16 million is not a whole lot in commercial real estate, but 16 million in funding for 32 deals since 2011. Platform has also partnered with a $9 billion real estate credit fund funding them proceeds. So this is really interesting innovation that, the feedback that they were getting from the, potential investor, potential sponsors was like, I don't know if my deal is going to close or how long it's going to take. And so they're stepping in and say, hey, bam, you're funded. And we're going to fund it offer it as a opportunity on the back end. Now, I've always been wondering how that's structured for Fundrise. Are they keeping a little bit of the juice for themselves? And, so I would imagine probably so. I mean, there's risk and return, so they're they're pre-funding the deal that's taking on some risk that they can actually sell the deal. So I imagine they're going to keep a little bit of the, the juice for themselves. But I thought that was really, really interesting and innovative. There's also this is from the thesis, wondering if the eBay model would work for real estate. Are we going to get to a point where we see all these deals listed and you go and buy, a share, a crowdfunding share like you would shop on eBay, and you check their feedback and stuff like that for credibility? It's more of a question than it is a projection, but they basically are saying, why can't some variant of the eBay model be used in the real estate space? Any thoughts on that? Are you a buyer on crowdfunding eBay? Yeah, but it seems like it's come a quicker, maybe smaller scale, smaller share cost, where we can just kind of look at a deal really quickly and kind of have feedback from prior investors on that developer or that sponsor and kind of make a decision. And it's interesting, right? I mean, it's an interesting concept. Um, there is what's his name? Lindsay. Yeah. Um, I know they did a piece, a crowdfunding piece on the deal, just to basically see what it was like. I think more for the novelty than anything. I don't think that it's caught on. I don't. I don't think it's caught on here, and I'm not sure how, widespread it really is, how ubiquitous it really is at this point. I do know that it was this time last year where all the regulations were getting ironed out. So it was literally like we had the class, and then like the next 2 weeks they settled on the rules. So we're talking about the tier 1, tier 2, Reg A plus stuff was settled, just less than a year ago. So I think it's taking a while for all this legislation to kind of work its way through, and for us to understand what it takes to comply. These changes sounded really good, and I was really, really optimistic about crowdfunding last year. But the people that I've been talking to, they're saying that there's even these boiled down regulations are formidable to overcome. Yeah. 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 Yeah, which was like a wake up call to me, because I was reading all these potential advantages of it, and I was just like, this is going to be the best thing to happen to commercial real estate in general, and young professionals, for you guys to get your piece of this thing, and then hearing that company's struggling, I think they're not doing business right now, right? That they closed doors or doing something else now. Really? Yeah. So those are kind of being some sobering, wake up calls that okay, maybe there are still some kinks to work out. I think they eventually do get worked out, and hopefully this will. But on the other end of things, I think there's some slides back there when we're talking about the REIT stuff. Is that it could be that the powers that be, the guys that are living it up, fat cat, they don't want this. If this is a potential source of capital that they've historically been controlled of, maybe we kind of put the kibosh on this. So we always have to kind of keep that in mind. Yeah, I think it's large. That was a number back then. I think we're seeing it growing exponentially. I mean, so like we're talking about doubling, tripling every year. But I think your point's well. It seems like there's risk inherent just in the raising of the equity, right? Which may be unnecessary to face that risk, right? Maybe it's just better we'll take our first loan to value, highest loan to value, then try to go to friends and family, try to get the rest of it. Maybe that's a safer route than go into uncharted territory. But hopefully these things will get ironed out. And so with that kind of in mind, we'll talk about kind of the trends, predictions that people are talking about what could happen in the future when we have driving cars and we're crowdfunding deals just like this. Yeah, absolutely. That's an interesting question. I do know that there's one deal that those of you that went to the capital markets thing last year, maybe you remember Ben talking about, is they wanted to advertise that they were a part of some big deal, maybe the new trade center, and they just basically rammed themselves into that capital stack. It was like they wouldn't take no for an answer. They kept bothering until they got a piece. And so they finally got a piece, and they could put it on the website. Hey, we're crowdfunding the World Trade Center, part of it. So I think there is some hesitancy of, some of these these capital stack providers to opening it up to a slice for that. So it seems to me that a lot of these projects are whole deals. It's a $500,000 renovation that the whole thing is crowdfunded. I guess so you don't have those potential clashes. Also, it's interesting. I think that an interesting use of this potential is they talked about how they can sweep in because they have this war chest of money that institutional equity providers are providing the crowdfunding sites, and they'll swoop in on a deal that's collapsing, that can't close, that has to close quick, something like that. They got the cash. They go ahead and pre-fund it. They close on it. They issue the shares behind it, and just because they can pick up a good deal that has that's time sensitive, they're able to make out with a good return. Well, that was pretty cool. Sometimes the speed is everything, right? So, all good points. So there's a trend. So some predictions. Their prediction is consolidation. So let me skip 2 slides. So the number of real estate crowdfunding sites has increased to around 70. That sounds like a lot. From over a handful just the past few years, and experts are anticipating a shakeout. The founder of iFunding, they've partnered with a $17 billion family office. Wow, that is a family office, right? Remember, that's a wealthy family that has enough money that basically have their own investment. So anyway, that's providing the platform capital. Predicts the number of platforms will be whittled down to 3 to 5, and that one or more could do an initial public offering. That's interesting. So we'll see about that. It does, at the capital markets event last year, some of the institutional guys were asked about crowdfunding and asked whether they're going to get involved. And this answers kind of pretty much seem to be, we're not involved yet, but we're monitoring it. We're keeping our eye on it. So I think this is definitely something on their radar that they might get involved with if the time is right, if the opportunity is right, if the all the things work out well. But this is usually how financial innovation occurs: is that someone tries it, they'll come out with a unique model, they'll try it, they'll do well, and then everybody else will follow behind. So it's probably going to take one of you guys to come up with some creative basket, product, idea, process, and then hit it big, and then everybody's going to follow suit. All right. Specialization. They think that sites are going to specialize based on scale of the project. Is it small, less than $1 million, or is it large? Types of properties, maybe regions, specialty. The business models will continue to kind of focus, either go the investment banking model route, developer portal, or is there some kind of other new model out there, or is there some kind of blending of models that can occur? Is crowdfunding going to one day replace mezzanine financing? Right. So we don't know a lot about that yet. We haven't talked about it. We have a whole lesson on mezzanine, but mezzanine can get pretty expensive pretty quick, and it could be that crowdfunding is a potential fills that old gap. Or does it replace the investor in the JV structure? Right. So maybe we have a sponsor where you have your equity, but maybe you don't have the connections to get the rest of that. Maybe your potential solution is to go crowdfunding. So it'd be interesting to see how that continues to evolve. Some more future trends: continued innovation, securitization. What could happen, and what's going to happen? So basically, making securities out of these crowdfunding shares. Can they bundle them? Can they pull them and then create securities off of those pulls, of those ownerships? What kind of derivative securities can you create from this? What kind of investment vehicles? Can you have a mutual fund of crowdfunding deals instead of just just buying one? Maybe that's like too much of a concentration. You have this big war chest of $1 million. You can go crowdfund a bunch of different deals. Maybe that occurs. Innovation and valuation. How do we, when you're getting pitched an idea, potential opportunity, is there some source, some kind of website out there, some kind of service that can help us out with the valuation part of this? Maybe like an independent third party. Maybe that's a potential opportunity for you guys, or maybe a group of you you can provide some valuation consulting services for a particular deal for that group of investors. Information providers, integration of social networks. So what we're saying here is that, so the idea is that the crowd can monitor this investment together, right? So if all of us have decided that we're going to fund this crowdfunding deal, we all have a stake in its success. So it could be that James is really good on the development side, can take a look at those numbers. Maybe some of you other guys take a look at the modeling. Someone else knows the legal side. Someone else, and so we're all sharing our ideas out there on the website and kind of collectively monitoring this thing and kind of analyze it and doing our due diligence together and making sure that we're keeping this project on. That's a pretty interesting idea, and that's I guess they call it Cloud. Their big thing is that integrating the social network side of things in there. What kind of future regulatory changes are we going to have? Will they ever scale down the accredited investor? Who knows? Do the powers that be don't, if they don't want that, then, you can imagine the lobbying efforts that are going on to try to prevent that from happening. It could be that they just, somehow decrease the cost for compliance with Reg A and Reg D. So, Reg A looked pretty good until you get to the blue sky law part. Maybe they have this like blanket, maybe they work out the, the state what do they call it? I can't think of the name. When basically all the states kind of pull in together and say, hey, this is our set of rules. Reg A would be perfect if that was the case. Or maybe states change their requirements. Maybe North Carolina can become the home of a crowdfunding friendly state with very minor requirements or requirements that line up with the Fed's requirements. That yes, we want to protect our citizens, but we're going to do so through the Fed's regulations, and so come here and fund deals. Maybe a state will do that. Who knows? Right. The one thing we do know, everybody seems to agree on, is that commercial real estate is underserved. So despite the large number of residential websites, and so we saw that, how many there were, like 70 or whatever, most of those are oriented towards residential. And so the online commercial real estate realm remains extremely underserved. This could potentially be a big growth spot. So again, I just think right now we're just kind of in the process of digesting the recent regulatory changes for things to, I think in a year or two, I think you're ready to start seeing more of this subject pop up. So let's go back and circle around and to the very beginning of this presentation, because we wanted to apply some certain terms, economic terms, to crowdfunding now. So how would you apply the term disintermediation to crowdfunding? What is that, and then how does that apply to crowdfunding? Yes, that is true. That's maybe on a direct basis, bring them directly. Exactly. Yeah, that's exactly right. So basically, this is saying get rid of, and then the second part. So this is getting rid of those intermediaries. So basically, it's just like Henry's suggestion in this, getting the investor and the sponsor, hooking them up directly without there being a bank or there being something else, some kind of financial intermediary involved. Right? How about deregulation? I think we all get that, why that's important, right? Democratization. How would you use the term democratization in crowdfunding?
Little guy.
Power to the people. Yeah. Diversification. We kind of talk. Yeah, yeah. The uncorrelation, potential this direct investment. That's why that's these family. It keeps on saying about how these family offices, how they like to fund deals. That's one of the reasons they have such a large portfolio. They can't put everything in stocks, everything's in bonds. They need some uncorrelation in their portfolio. Direct investment in real estate is a great source of that non-correlation there. Monitoring. How would you? Monitoring is kind of what we just talked about there at the end, where if all of us are sharing ideas about this investment online, maybe we can collectively make sure that the sponsor does what they're supposed to be doing and that type of thing. All right, how would crowdfunding be efficient? What kind of efficiencies do you see involved? All right, so maybe, yeah, absolutely. A lot of times reducing costs, maybe the dissemination of information, the dissemination of deals, like we were just talking about earlier, the matching process, that's going to be more efficient. How about transparency? Mm-hmm. Yep. Yep. I would agree with those points. Very well said. How about heterogeneity? How's that term get used? What's that? Non-similar? Yeah, so, I mean, not everybody's an accredited investor, right? Not everybody wants just more and more exposure to real estate through REITs. We have different investors. We have heterogeneous investors that have heterogeneous needs, and there's heterogeneous assets. And so we need to continue to have financial innovation that meets the needs for all those different folks. And so is crowdfunding the answer to everything? No. But it certainly does seem like it's an answer for some folks. And if what it takes to get there, some deregulation and some technology platforms, it seems like that should happen. So we'd say that crowdfunding can help meet the needs of heterogeneous investors out there. All right, any other questions, comments?
Just a sidebar question.
Sure.
Some of those you were showing where it had like the websites, like there's Brownstone in Brooklyn or whatever.
Yeah.
It seems to me that an even more sophisticated, wealthier broker could have sites scanning those to jump right in and say, oh wow, Kip and his little group in Charlotte found this great deal in Dilworth that could make 70%. I'll write a check for it right now.
Mm-hmm. Yeah, and so we have these small deal sizes as far as the shares, but there'd be nothing depending on the different regulations or the different exemptions where it was registered on. If it's looking for $2 million and you want to put in all $2 million of it, you could do that.
Yeah, or just screw your site over. You know what I mean? You did the work for it. You found it. I have some gurus, an IT guru. I want you to go build a data mining site for me to go find all these guys. And, you're out there soliciting investors. Thanks, you did your job for me. You can upgrade this investment. Let's come from behind and take your investment for it. Where you still.
Oh, you mean like a website taking someone else's crowdfunding deal?
To scan those websites
Uh-huh.
to look for, because you kind of have to disclose this, right?
Right.
Say, I'm Kip and I own Charlotte Investments and we have this potential one here that I want to crowdfund.
Mm-hmm.
And here's what we can do.
Oh, I see what you're saying.
If I'm coming in and
Right.
spying on your website
Right.
and I'm sophisticated enough and have the cash, you're doing all the grunt work for me. You're doing all the finding the deals for me.
Right.
And then write a check for it.
Yeah, I mean, I'm just presupposing that they've tied up the deal. They've tied up the asset, right? And,
That's why I was wondering by the ones you were showing, because it almost looked like they were doing real estate advertising. Hey, we have this potential that we need people
Yeah.
to invest in. Like, you kinda have to-
but to your point, if the project doesn't fund, maybe they can't close, and maybe, like you said, maybe that's maybe there's a vulture out there that swoops in and collects. But yeah.